Okay, today we're going to look at the recording of salaries and wages in the books of the business. First, we're going to look at the salary journal. The salary journal is used to record the gross salaries, the deductions, the net salaries, and the employer's contributions towards salary employees. As salaries are paid monthly, the salary journal is drawn up at the end of the month and posted to the general ledger. Okay, so this is how the salary journal look like. It will have a heading. It doesn't show the heading here, but the heading will be the salary journal of Lanka traders for the month ended 30 September 2012. A column for the employees, gross salary, the different deductions for the total net salary, the check number issued to each employee, the employee's contribution with a column for each and a total. Okay, so let's see. Look, we will first look at the calculations for Zolo because it will be basically the same for the other two. So Zolo's name, Zolo, his gross salary is 4,600. The pension fund for in the information states that it's 3% of the gross salary, so 3% of 4,600 is 138. UIF is straight 20 Rand. Medical aid is 50 Rand per family member. He is married with no children, so there are only two, so it's 50 Rand times 2, it will be 100. Pay as you earn for Zolo is 30%, so we need to take his gross salary times 30%. That equals 1,380. If we add the 138 plus the 20 plus the 100 plus the 1,380, it gives us a total deduction of 1,638. Okay, now we can calculate his net salary, and that is the gross salary minus the deductions. His gross salary is 4,600, his deductions 1,638, and that gives us a net salary of 2,962. The first of the checks will be issued to him, 938. So now we can look at the employee's contribution. The information says the contribution UIF on the Rand for Rand basis, so that's the same amount. But with the pension fund, it's 50 cents for every 1 Rand. So for the pension fund, we will take what he have paid, 138 times 50 cents, will mean the employee's contribution is 69. UIF will be the same, 20 Rand, and a total of 89. So we can use the same principles and complete it for the rest. The next is Yama. His gross salary is 5,200. 3% of that gives us 156. His UIF will also be 20 Rand. He is married with 2 children, so it's 50 times 4. That gives us 200 Rand for the medical aid. His tax is also 30%, so 30% of 5,200 is 1,560. Now we can add all his deductions together, subtract that from his gross salary, and that gives us a net salary, and the next check will be his. Employee's contribution is for pension fund is 50 cents. So what was his pension fund? 156 times 50 cents gives us 78. UIF will be 20 with a total of 98. Then we can move on to Zuma. His gross salary is 6,400 times 3% gives us his deduction for pension fund. His UIF will be 20. He is divorced with 2 children, so that's 3 people times 50. It gives us 150 for medical aid. And his Zuma, his pay as you earn is 36, so 6,400 times 36 gives us 2,304. Add up all our deductions gives us a total deduction of 2,666. Subtracted from the 6,400 gives us a net salary of 3734. And the last tick number will be his. Pension fund is again what he contributed, 192 times 50 cents. UIF stays the same with a total of 160. Now we can add up the column totals, and we start off with the gross salary, the total pension fund, UIF, medical aid, pay as you earn, total deductions, net salary, total pension fund fund contribution, total UIF contribution, and total contribution. That is the journal, which now need to be posted to the general ledger. Now remember, the double entry rule still applies. For every debit, there must be an equal credit. Okay, wages journal will look a little bit different. The wages journal is used to record the gross wages, the deductions, the net wages, the employer's contributions, and the wages is drawn up and posted weekly to the general ledger. So per month there will be only one salary journal, but there will be 4 wages journal, one for each week. A normal working week usually consists of 40 working hours. That will be considered normal time. Additional hours are considered to be overtime. Now, posting to the general ledger, we must determine what is the expenses to the business. The expenses. Posting from the salaries journal takes place monthly, while the wages journal is posted at the end of each week. So the process involved in posting from the salaries journal and the wages journal will be almost identical. So when you can do the one, you can also do the other. And we will use the salaries journal prepared in the previous example to explain this process. So there's the journal. If we look at that journal, there are 3 expenses. That is an expense to the business. 3 expenses. The salary amount. The gross salary is what it costs the business. 16,200. That is an expense to the business. What else is expenses? Contributions. The pension fund contribution as well as the UIF contribution. That is the expenses for the business. Whenever a business incurs an expense, the expense must be debited in the general ledger. So the gross salary in the nominal section will be debited, the pension fund contribution will be debited, and the UIF contribution will be debited. So our first step in posting the general ledger is to create and debit the 3 expense accounts. Salary, pension fund contribution, and UIF contribution. So salaries will be debited with 16,200. The pension fund contribution will be debited with 243, and the UIF contribution will be debited with 60. Now that gives us debits. Now for every debit, there must be a credit. The next part is the liabilities. We have now figured out what is an expense to the business, but the business now owes these amounts. And when we owe money, it is called a liability. Once we have established which accounts have to be debited, we must now decide which accounts need to be credited. Remember, the fundamental rule of the accounting states that for every debit, there must be a corresponding credit. Okay, back to the salary journal. The gross salaries account of 16,200, which was now debited in the salary account, is now owed to what? We owe them. First, we owe to the pension fund 486. Then we owe to the UIF 60 rand. To the medical aid 450. For SARS for pay as you earn 5,244. And then the employees, we owe them 9,960. If you add all those together, it's equal to the gross salary of 16,200. Okay. So that means where we have debited the salary account with 16,200, we need to credit each of those respective accounts with those amounts, and then we will have a debit for each, a credit for each debit. Now, people or organizations who are owed money are called liabilities, creditors, and are credited in the books of the business. Therefore, when posting from the salaries journal to the general ledger, we must credit each of the liabilities shown above. So, the pension fund will be credited with 486. It is a liability and therefore it's going to be in the balance sheet section. The same applies to all the others. URF is a balance sheet and we will credit it with 60 Rand. Now you need to notice that the expense to the business, which was debited with 60 Rand, the account name is URF contribution. Here it's just URF because the money is owed to the URF. Also, we will credit the medical aid and we will credit SARS pay as you earn. And then the account name for the salaries that's owed to the employees will be creditors for salaries. The salaries that we owed, that is the net salary, is credited with 9,960. So that double entry part is now complete, except for the employee's contribution part. Finally, the employer contributes are also owed to the pension fund under UIN. So these liabilities must be credited again. They will have two entries. The pension fund will be accredited again with 243 and the UIF with 60 because that is also owed. Now we have completed the double entry rule